what needs to go right for this to happen?
The reason we're not yet profitable is because
NextGel is built around a niche material, medical grade hydrogel. Only two facilities in the world make it this way, one owned by Medtronic and the other by NextGel.
But Medtronic does not do contract manufacturing, they don't do consumer products, they don't compete with us. And in fact, Medtronic is one of our customers.
The company has burned cash for years, acquired small brands like Kenkoderm and Silly George to diversify, and now says it's close to break even.
If we do what we're supposed to do and we operationally get to a profitable business that gets stronger every year, things will take care of themselves.
At the center of it all is CEO Adam Levy, who has to manage scarce capital, defend a fragile supply chain, and convince partners like AbbVie and Medtronic to stick with them.
You're always talking to your customers to find out what they want next.
Today, we'll ask him how he plans to do that.
Every division we have is profitable. The reason we're not yet profitable is because
Guys, let me tell you a 30-second story, and I promise you won't regret it. So when I started to take investing seriously, I really didn't have anyone to discuss my ideas with. I knew no one in the investing space, and therefore my process felt kind of lonely and very slow as well. So I went on and found a community of serious microcap investors, people that actually like doing the work. And I'll let you in on a little secret. It's called microcapclub.com. Members have profiled more than 1,300 companies, and over 300 of those have gone on to become multi-baggers. That's the power of this group. The awesome thing is that you'll get exposed to ideas well before institutions ever notice them. And if you want to find great businesses and surround yourself with some of the best investors in the world, head to microcapclub.com and consider applying to join or becoming a subscriber. That's microcapclub.com. Nothing in this conversation is financial advice. I may hold positions in some of the companies we discussed or have other interests. I always aim to stay objective, but please take everything with a grain of salt and do your own research.
Adam, I wanted to start by maybe asking you if you can talk a bit about yourself. What's your background and why did you join NextGel in the first place?
So yeah, it's kind of an interesting and a little bit of a long story, but I'll be happy to share it with you. I spent 25, 26 years building a roll-up strategy in music and record labels.
Okay.
I did that from about 1983 through to 2009 when I sold that business. I then ended up reconnecting with a buddy of mine from Johns Hopkins, and we started a small boutique investment bank. I did investment banking. Kind of an interesting transition, right? You're running one company for many years, and now you're looking at as investment banker, you're looking at multiple different companies. And interestingly, one of the first deals that I worked on as an investment banker was the parent to this facility, which was called Allocation Biomedical. Allocation was a wound care company. Did a very successful transaction, a raise for them, but I kind of watched them run the company into the ground a little bit, too much expense, too expensive a sales force. And one of my investors in that company that did that deal had a daughter who happened to be 12 years old at the time. This is before I was CEO. This is going back to like 2016. And, she was a point ballerina competitively, and their feet get torn to shreds, right? Number one reason young girls quit ballet is foot pain. And his wife happened to be a nurse, and he cut up some of the hydrogels. The hydrogels were still part of the company's profile at that time, and put them on her daughter's feet. And within 2 days, she was dancing pain-free. And now her friends want some of that stuff. And he kept asking me for more and more samples. And eventually, I said, Rich, are you beating your daughter? What are you doing with this stuff? And he said, no. And he explained it to me. And we thought there could be a little business there. So we made a product, which we still sell to this day, called Gaynor Minden's Dancer Dots. And within 3 months, we were selling 1,000 jars a month on Amazon at $24 a jar. And it made me think about what other technologies and what other opportunities there are for this technology. And later on in 2019, when the facility got into real financial trouble, there was an opportunity for us to step in and buy it. And I went back to running one company again.
Nice. Yeah, that's very interesting. Actually, a lot of different backgrounds in there, like different industries as well. And can you tell us a bit more about your music venture? So essentially, can you explain a bit more about that? I'm just curious, out of pure curiosity. Honestly, doesn't have anything to do with NextGel, but what was sort of the business model there? And can you guide us through why did you sell and like the whole history behind?
Sure. So the parent label was called Warlock Records. We bought other labels, Quality, Streetwise, throughout the years, to name just a couple of them. And I was a fairly successful or very successful record promotion man. So I could get my records played on the radio at a discount to what everybody else was paying.
Okay.
And running record labels, and a lot of them got in trouble, right? A lot of record labels were run by very talented people, but they weren't business people. So they would get a little hot. They'd have a couple of hit records, and they'd think, well, this is easy. We're just going to have, we're going to have twice as many records out next year, and we'll have twice as many hits. And it just doesn't work like that. It's hard to get a hit
Mm-hmm.
record. And
Yeah.
so they would get into financial difficulty, and I would come in and, give them some seed capital, buy 50 to 100% of the business, and slowly build up the catalog portion, which allows you to then take shots with new artists. And
Mm-hmm.
we were fortunate. We had some pretty big records. I probably had 10 or 11 gold and platinum albums during my
Wow.
time and tenure, and a whole bunch of others that were a little less successful. But we built up to be one of the larger independent labels, still very small, but a good size independent, group of record labels.
That's pretty cool. I was just curious. Honestly, it's an industry I know nothing about, so it's always nice to learn something new. Nice. So now, kind of transitioning to hydrogels and your current venture and current company. So what excites you about this industry, and what makes it interesting for you? Because obviously you seem like a pretty ambitious guy, and you wouldn't just pick a random industry and like with poor economics. So yeah, just let me know.
Well, it was interesting because of the uniqueness of the facility and the uniqueness of the technology. It's interesting because, again, we have a little bit of that exclusivity, but it's amazing to me the utility that sheets of water, which is essentially what we make, could have
Mm-hmm.
as a baseline technology. It has applications, and you've seen it through some of our deals, in cosmetics. It has it in medical device. It has it. We make conductive pads. We make sensors. We can do all sorts of things with this base technology that open us up to a very wide variety of opportunity. Really, pretty much anywhere that a medical device interfaces with human skin is where we shine, because we are very gentle to the skin. We're biocompatible. We're non-irritating. So think about the elder market. Think about all these opportunities, and it's really kind of quite exciting.
That's nice. Honestly, I had an interesting experience over the last couple of days because someone that's very close to me had to do like kind of a heart exam, and so she had to wear this machine like that this machine for 24 hours, and she had to put like these patches on, and when she had to remove it, it was extremely painful, and uh, she actually got some like skin taken off through the patches, and so it was like the perfect timing to understand why your product what's the problem you're fixing basically. And so I think this is the perfect segue to explain like to new investors or people that don't know what NextGel does, like what we actually do and how do you describe the company in simple terms for those people.
Sure. So first of all, if I can ask, how old is your
Yeah.
friend that had the heart murmur?
She's 16.
Okay, so imagine if she was 85 and had fragile skin or crepey skin or had some kind of a skin allergy or had sensitive skin. The problems get exacerbated even much worse than the discomfort, which is, not to say that it wasn't severe, but much
Yeah.
worse than that discomfort as well. So where we shine, we use an electron beam accelerator. It is a very, very large machine that takes up about 11,000 square feet with 8-foot concrete walls. And most hydrogels are cross-linked, water and polymer, and they're
Mhm.
cross-linked using chemical initiators. Those chemicals are invariably skin irritants, sometimes carcinogens. They're really not suitable for med device applications. They're certainly not biocompatible, and they don't provide the same sort of adhesion that our gels do. Obviously, acrylic adhesive can be just as difficult and tough to remove and just as painful. So what we make is a product that can be up to 95% water, but the more adhesive gels are more like 60% water, which is moisturizing while it's adherent. It removes easily. It doesn't pull your hair when you take it off. It doesn't tear the
Mhm.
skin. So again, anywhere that a medical device is going to spend an extended amount of time on human skin is really where we shine. And that's just the application for med device. Then when you get into the world of beauty and cosmetics and wound healing and those types of things, there's lots and lots of other applications and products, which we'll talk about, I guess, as we get to the other branches of the company.
Sure. Yeah. So I guess you already spoke for what makes hydrogel unique. I wanted to kind of go into the more business side of things. So what makes NextGel's hydrogel different from others? And like, how is this not a commodity? Obviously, you talk about the electron beam accelerator, which seems like a pretty fancy machine. Um, but yeah, maybe you can just expand a bit on this.
Yeah, so the energy from the beam allows for that cross-linking. There are only two facilities in the world that make electron beam hydrogels. We
Hmm.
own one. Medtronic, very, very large medical device company, owns the other. But Medtronic does not do contract manufacturing. They don't do consumer products. They don't compete with us. And in fact, Medtronic is one of our customers. So
Hmm.
Medtronic makes one kind of gel. It's called blue gel. They make 2.4 million pounds of it or something like that a year. They don't ever want to come offline. They're a small customer for us. They, not a huge number, but we do support a couple of their medical devices that require a certain type of gel pad, and they'd rather have us make it than come offline to make it themselves. So we really
Right.
don't have any competition in the markets that we're trying to get into, at least not today.
Mm, that's interesting. And so, like, for example, when I go on Amazon, this is a very honest question. Like, when I go on Amazon and I type like hydrogel pads or like something like that, there's a lot of things like for the eyes, like cosmetic products. What's the difference between those hydrogels and your hydrogel? Because um, from what I understand, is like the manufacturing procedure that makes it less kind of pure, so less they have less water or something like that. But maybe you can give me a better picture.
Yeah, it depends. So if you're going with a solid hydrogel mask, it definitely has less water. Now
Hmm.
there are hydrogels, because remember, all a hydrogel is a high water content substance
Yeah.
that where they basically put like little discs or little pads or cloth in goop, right? It's a liquid
Hmm.
hydrogel. So that
Exactly.
can be very high water content, but what ends up happening is you put the mask on your face, it smears around, it slides down your face. You're basically just putting like goop on your face as you could take cream out of a jar. What we make is a solid material that is gently adhesive, can be 90 to 95% water, and you can walk around the house and vacuum and do whatever you want to do and cook or whatever while wearing the mask. We can deliver and
Mm.
have delivered over 200 different combinations of additives, from hyaluronic acid to peptides to vitamin C. So it gives us a chance to really make some very unique beauty products
Hmm.
in that segment. And that's one of the reasons when people always ask me, well, what would you buy Silly George for? Exactly for that
Yeah.
reason, because that's going to be our outlet to making and introducing the beauty world to our hydrogels.
Mm. That's very interesting. And so for someone that looks at your company and tries to get a sense of the industry itself, like it's there's not a lot of yeah, hard data or easy to access data on the industry and how rapidly is expanding, because it's such a like new thing, I guess. So can you give us a breakdown of the industry, like the growth of the industry, and maybe what other players are playing in the wider industry? Maybe not exactly in the niche that you're trying to attack, but in the wider hydrogel space.
Well, we touch a number of industries, and hydrogels can be very varied. There's a very robust and flourishing hydrogel market for pharmaceutical injectable liquid hydrogels. Right, that's
Hmm.
nothing like what we do. We're not a pharmaceutical facility; we're a medical device facility. So, when you're talking about hydrogels in general, it's a massive market with many prongs, many of which have nothing to do with each other. The
Hmm.
the industries that we touch on are the sorts of medical devices I described, beauty and cosmetics, dermatology, skin treatments, surgical drapes, drug delivery. These are the places that we shine, and those are each very, very large markets, which we feel we have opportunity in.
Mm, got it. And what sort of other players can investors look at just to get a sense of of the like the wider industry, or what other players are playing more in the niches that you are attacking? Because obviously no one has the same machine that you use to produce these hydrogels, but I guess there are also like competitors from overseas. So yeah, just maybe you could explain a
So
bit
yeah,
better.
there's a fair number of overseas competitors who make chemical hydrogels. Again,
Mhm.
not suitable for sensitive skin applications, but they are used for like the cheaper TENS electrodes that you might get when you go get an EKG at your doctor, where
Yeah.
you don't have sensitive skin if you're not an elderly patient, and the electrode's on you for a minute and a half. It's not a big deal.
Yeah.
There are some big players like Sekisui and a couple of companies that make those. But really, if you're looking for a medical grade hydrogel, and the FDA is really tightened up. If you're applying for a 510(k) for a new medical device, and that device is going to stay on the skin for a period of time, they really want you to have a biocompatible, gentle hydrogel. If they find you have to do studies to show you're not irritating the skin, you're not going to damage the skin in any way on removal. So all of that leans into us being a better choice.
Got it. And can you also guide us through through the whole process of being approved by the FDA? Like, what does it take? Uh, how easy is it for someone to do something similar in that sense? And maybe also run us through the costs of filing for something like that.
FDA and ISO are regulatory agencies. FDA comes and inspects our medical devices. They're mostly interested in Silver Seal because that is an FDA cleared product. But they do inspect the entire facility. ISO is a certification that allows us to sell our products all over the world. Although different countries have other things that they require on top of ISO, often it's not quite as simple as that. But though there is a cost to maintaining the facility in that way. Mostly it's in your systems. But there are inspections. We have a group that comes in and does regular inspections every year, semi-annually, and there's a cost associated with that. It probably does cost $30,000 or $40,000 at least a year between FDA and ISO inspections.
Okay, got it. It makes total sense, and maybe it's not as expensive as I thought it was. It's more like of a time draining thing, right?
Well, let
It's
me be clear. It is very expensive to get certified the first time, hundreds of
okay,
thousands,
okay.
right? But
That's the
once
maintenance.
certified, assuming you don't do anything egregious, then there's a maintenance cost that's much lower.
Okay, okay, that makes perfect sense. And um, also on the side of IP and trade secrets and like manufacturing know-how, how easy? Let's say you're kicked out of NextGel and you really want to have revenge and create a competitor. Like, how much would it take for someone with your knowledge to replicate what you're doing?
Well, first of all, I don't even have all of the knowledge. It is a very specified area, and we're fortunate to have some folks who've been doing it for a long time who really know how to do
Hmm.
it. Um, electron beam technology has been around for decades. There are no patents around just the electron beam, but we have gotten very strong patent protection on things like our surgical drape. Applications and inventions surrounding an e-beam hydrogel are wide open because no one really has them to file patents for them.
Hmm.
So we do work on our patent portfolio when we invent something novel and new using our hydrogels. Drug delivery would be another example of that. But just the idea that you have an electron beam accelerator in and of itself isn't patentable. There is a lot of secret sauce, though. The way you blend the polymers, for example, we don't let anybody in our blending room, so you don't
Hmm.
just get a mush that's unusable, is a little bit of an art and a science. If you wanted to build a facility like ours, you'd probably need about $10 million. It would take you a few years to build it just for the infrastructure
Okay.
as much as the accelerator itself. So look, there are some barriers. Obviously, if we became a $300 million revenue of hydrogel became the next big thing and, went beyond my wildest dreams, would we get competition down the road? Probably. I hope I live that long.
Got it. Makes sense. And I'm sorry if I'm asking like really basic questions, but I also want to understand like sort of the manufacturing side of things. And I was like an engineering graduate for a long time, at least like for a couple of years, and so I like the technical side of things as well. Maybe I don't know if you're the best person to ask this, but um, I want to understand also on the electron beam cross-linking process, like uh, what happens? First of all, do you use that process for all your products? And secondly, what happens if the machine breaks or there's like a downtime on the machine or you have to do some maintenance on the machine? So maybe you can give us a better picture of that thing.
So it's definitely used on all of our hydrogel products. There's a couple of minor exceptions, but the bulk of our work goes through the machine. The
Okay.
accelerator is a very, very reliable machine. They can run all day and all night. This particular machine is about 22, 23 years old, but it's not uncommon for them to last much longer. They do use electron beam accelerators are used in things like vulcanizing rubber and other industries as well. There is a fairly robust service, supply availability, and we always keep spare parts in our facility. So yes, things can happen. A chiller can go out, and a beam tube can go out, but we always keep spares in house. If one of the spares is used, we then replace it right away. Doesn't mitigate all downtime, but I would say that in the 5 years I've been at the facility, total amount of time we've been down is probably less than 2 weeks, 3 weeks maybe.
Hmm. Okay.
Out of
Yeah.
5 years. Yeah, it's been a very reliable machine.
Sounds manageable.
Yeah.
Yes. And now let's get more into the business segments side of things. And so you have like these consumer branded products, and they are now like the largest driver of revenue, right? It's growing the fastest, and it's interesting because you acquired some of the companies that lie within this segment a few years ago, and they grew super fast. So that's a very interesting thing. So how do you balance like this growth with contract manufacturing stability? Because obviously that this might be a bit more lumpy and less stable. So yeah, how do you think about this?
Well, we actually ended up in branded products a little bit by accident.
Yeah.
I did not want to start with branded products. My original thesis when I became CEO at the end of 2019 was to do custom and white label. And what I meant by that
Hmm.
was, find a business that has a successful lotion, cream, or gel. They spend millions of dollars advertising it, and I can now offer them a patch, right? Because you couldn't use acrylic adhesive for a lot of these applications because of the pain and the irritation, and you certainly couldn't use chemical hydrogels. So we went out and I went to several conferences right away. I went to an ECRM, which if you're not familiar with what that is, it's like speed dating for companies, right? You have 50 meetings and they have to come because you're paying. And really
Yeah.
we felt maybe like one or two of these companies would like what we're doing, but would learn something. And we left that first meeting with 28 requests for NDAs. And what we failed to
Wow.
understand about our own appeal going in was that they'd walk in the room and we'd put the gel on them and they'd go, wow, that feels amazing. You're telling me I can there's no chemicals in this and I can deliver my additives. There's no PBAs in it. And everybody got very excited. Had a similar response when I went to an international sales meeting in Milan in February of 2020. Unfortunately, I was in Milan in February of 2020. My friends teased me that I was patient zero for COVID here in New Jersey. And
Yeah.
so the world kind of shut down at that point. And we didn't know what to do. We were a private company. We got some PPP and idle money. And I'm driving into a medical facilities who are still open, but I'm driving in. There's really nothing to do. And it's like, well, what do we do now? And we said, well, maybe we just make a couple products and throw them up on Amazon and see if anybody likes them. And in the end of 2020, our first product came out. And that was the impetus. It took off very quickly. We had a 7-figure business on Amazon fairly quickly. Now, remember my background, I'm a roll-up guy. I did roll-ups of record labels. I look for things that are struggling. It's the fastest way to grow what you're doing. So finding little tuck-in acquisitions like Kenkoderm and Silly George that had synergies with our ethos, but had good solid financials to them as well, was something that we look to do, and we're going to continue to look to do.
Okay. Interesting. And so can you guide us through like the rapid growth of Silly George? What drove that? And uh, were you expecting it in some way? And if not, like how did you approach this whole thing? And also what it means for the bottom line. So what sort of unit economics do you have on those products? I don't know how much you can share, but obviously that would be extremely interesting for investors.
So I mean, I can walk you through it, and you can glean from it what you want about the unit economics. You'll see some of it. It'll give you a guideline without going into great detail. That might be overstepping. So when I looked at Silly George at the time, and we announced to the street, it was doing about $2 million a year in revenues. They were generating about 10% contribution margins, so 200,000 a year. We bought the business, this is all public record, for $600,000, 400,000 in cash, and 200,000 in stock. There is a little profit participation, 20% of the profits for a period of 4 years with the previous owner, which I like because it keeps someone that's really knowledgeable about the business and help build the original business involved, so you have a resource to go to. But my thought was, okay, that's 200,000 a year. I get my money back out in 3 years. I get my cash out in 2 years. But I was pretty sure I could increase that 10% to 15% just by looking at the inefficiencies that I saw. So in that case, I'm getting fully paid back in 2 years, and I'm getting my cash back out in a year and change. And it seemed like a solid deal. But there were also some synergies. One I already talked about was now I've got a beauty brand. Now I can make my hydrogel under eyes. I can make my hydrogel face masks, and we can brand them to 250,000 customers of Silly George, whose emails we have, and we can begin to launch products and get exposure for ours. But the other fascinating thing to me was this was a beauty brand that was going through a little bit of financial stress and hadn't released a new product in 2.5 years. And in beauty and cosmetics, that's the kiss of death, right? There's always a new ingredient. There's always a new fad. You're always talking to your customers to find out what they want next. And they just didn't have the wherewithal to put these products out. And they had this product, these pop-on lashes. And I gave them, I joke with everyone, I gave it to my technical product analysis team. And by that, I mean my 16-year-old daughter and 8 of her friends. And they came back and went, Dad, these are amazing. They're so fun. They're cool. We love them. So it was a good gamble as far as I was concerned, but we did get a little lucky, right? The pop-on lashes came out. They took off right away. We've increased the efficiencies of Silly George to where, in the first quarter that we owned it, it was growing really fast. We didn't make as much money as we are now with it more stable because now we've optimized it. So, think about that 15% as being the low point of the contribution margin. And we're really aiming for 20 to 25% contribution margin.
Wow, yeah, that's extremely good. And for the people that are new to this case, can you break down what contribution margin means? Because
Sure.
maybe.
So contribution margin is the margin, and we use that rather than gross profit. Our gross profit numbers are all over because of the different ways things are calculated, right? The most expensive thing in a beauty consumer product is advertising. So contribution margin is the margin that's contributing to your bottom line after paying for everything, paying for your advertising, paying for your people, paying for everything else, because that's really what matters for that kind of a business.
Perfect. Yeah, I think it's always like, as an investor, when you come to a new case, there's always like a new metric or something that's more relevant to that company, not so relevant for others.
Well,
And
some
yeah,
I don't mean to cut you off, sorry, David, but
no, no.
something else interesting to your listeners is, as important as Silly George is, as important as that revenue is to us and that profit is to us, to our bottom line, nothing affects our bottom line like adding a new gel customer. Because our facility is at 18% capacity now. It was at 4% capacity when I walked in the door. So Silly George, you think about 15 to 20% contribution margin, right? So you do $1 million in sales, you make $150,000 to $200,000. But on the gel side, because my overhead is so fixed, really the only cost for me to add another gel customer is cost of materials. And the cost of materials on our gels can run as low as 21% and as high as 38%. So now you're talking about, 79 to 60 cents on the dollar falling right to the bottom line. So as important as Silly George, as important while it is, we really are also focused on growing the contract manufacturing business, which is growing quite nicely, because that actually drops more profit to the bottom line per dollar of billing.
Yeah, I think that's extremely interesting, and I'm glad you interrupted, because I'm curious to know, how do you get a new customer? Because like, this is a fairly kind of new technology, or at least new application to this technology. So how does it look like trying to get these huge multi-billion-dollar companies to pay attention to you? And maybe just guide us through that process, because for someone that doesn't run a company and doesn't have to sell to these big corporations, maybe they don't know so much, like how much does it take, and like the timing and the bureaucracy you have to go through. So maybe you can just talk a bit about that.
Sure. So there's a little bit of everything there. I mean, the good news for us is that our product is very unique. And if we solve the problem, there's a good chance that we'll get it. And I always draw the comparison between, and I get investors that ask me all the time, like, well, how did you land Stada as a partner? And how did you land AbbVie as a partner?
Exactly.
And the stories
Yeah.
are completely different. So
Mhm.
Stada was looking for a commercialization partner and a marketing team here in the US. And I basically pitched them that we know what we're doing in terms of optimizing advertising, pointing to things like Silly George and other success stories that we had. And this is how we do it. And, they'd had a less than optimal experience several years ago when they tried to come into the US. And we kind of pitched, along with everybody else, how we would do it. And they chose us. With AbbVie, they came to us with a technical problem for the Resonic machine, and within 2 or 3 weeks said, there is no plan B, we need your gel. So all we had to do was not be incompetent, right? We had to pass the inspections, we had to be responsive, We had to get them samples on time, but they were going to pick our technology because our technology was the one that worked best with their machine. So when you have that, where you clearly are the best choice, not everyone's going to pick you because people will go for the cheaper choice or they'll go for something else. But when you are the best choice, you can land a high percentage of business. Now, the challenge with those big companies is there's a 2-year onboarding process, right? By the time you do validation, verification, inspection, all of those things, you're creating material for them in smaller orders for their studies, shipping studies, shelf life studies. It takes a while before they really crank up and they become, good sized customers. But you see us onboarding more and more. We announced in an 8K that iRhythm is now a customer. Obviously, we're anxious for AbbVie to get started. Cintas is now a customer. Owens and Minor is a customer. So, we started working on some of those customers, when the pandemic kind of started to die down in 22, 21, like that's how long it's been. But now they're all coming online and we're seeing the growth in the revenues.
Nice. Yeah, I think that's very interesting just to understand also because I myself, like as an investor, sometimes just look at the numbers and like I don't connect the dots between the numbers and the actual work behind. Like there are actual people trying to get these customers to yeah, to just buy from you and convince them and actually onboard them, and the whole process takes a while, right? Yeah, so that's very interesting. And I wanted to touch a bit on Kenkoderm, which was immediately profitable when you acquired it. So I want to ask you, first of all, how did you got such a great price for a profitable business? And are you using that as a blueprint for future acquisitions? So how has that shaped your acquisition strategy, if it shaped in any way?
Yeah, so there's a difficult space for the private operator doing direct to consumer, where if they're doing 1 to 2 to 2.5 million in sales, it's very hard to make money. They can't really leverage what they're doing. So if they're making even a little bit of money, it can be attractive to us. I'm not interested in buying something that's losing money and trying to turn it around necessarily. I'm not a big believer in that philosophy unless I can see right away there's overhead to be cut and that somehow the synergy of the two companies come together would make it immediately profitable. We want to do accretive acquisitions. They're not easy to find. I mean, I bought Kenkoderm about 7 months or 8 months later. What was it? 7 months? Yeah, it was about 7 or 8 months later. We bought Silly George, and I've been looking ever since. And we have
Yeah.
not closed a deal since Silly George, and it's been more than a year now. And there's some things I'm looking at now. I'm very open with that in all my calls. I'm always looking at companies to try to acquire, but making good acquisitions is more important than making a lot of acquisitions. So we'll find something. We'll find something that's accretive to our bottom line, but we're not going to push it or rush it. That's where you get in trouble.
And so, how do you underwrite these acquisitions? Like, what sort of returns are you looking at? Obviously, you talk about Tilly George. Okay, maybe it's a 3-year payout, 1 year and some change. But in general, what's sort of your hurdle right there?
Yeah, you really wanna be in a position where you can get out in 2 or 3 years, get your money back, have the value of the business from that point forward, and have some synergistic upside, right? Have the
Hmm.
ability to say, okay, well, if this goes well, I can do even better. So Kenkoderm has been a solid single, right? It's profitable, it does what it does. But now we're going to be launching in Europe. Now we're going to be releasing an eczema line. So it's something I can also build off of and grow off of so that when we look at it, not 1 or 2 years during the payback period, but 4 or 5 years down the road, it could be 3 or 4x what it was when we originally bought it and paid for it, because we have the infrastructure and we're doing the work on it.
Right. And sort of as a student of roll-ups, I've seen a lot of cases of failed roll-ups, and it's very likely and it's very easy to find like failed roll-ups that were over leveraged and then like yeah, they went bust, or like they just overpaid for the acquisitions. So what guardrails do you have in place to avoid making the mistakes other people have made in the past, and what makes you different from those failed roll-ups?
Well, you hit the nail on the head. I mean, don't overpay for things. Don't buy. Don't reach and extend yourselves for things. We're a little bit in a fortunate position that we don't have that much money, right? So we're not going to go out and we don't take
Yeah.
risks that can put the entire business at risk, right? If someone came to me with a company that looked really hot, but it was $50 million, and if it didn't work out, it would basically erase all the work I've done here for 3 or 4 years. As good as that might look, don't let greed get the better of you, right? That you can't take that risk. It's too big of a risk. Understand your own risk profile. Understand, what puts you in jeopardy and what doesn't. Stay within your home field and do what you know. We also don't take on any debt at this point because until we're EBITDA positive and can service debt out of cash flow, um, you know, using debt to buy something and then hoping you can pay it back is not a good strategy. So
Yeah.
you'll never see
Yeah.
us do that either.
Nice, that's perfect. And obviously, we can't talk about NextGel without talking about AbbVie. And so I have a huge question here from a listener, which I'll try to break down in small digestible parts. So essentially, here it says like AbbVie invested 550 million in Soliton's Resonic, right? So where your hydrogels are key, how should investors think about the significance of the Resonics rollout for NextGel? And you mentioned you are confident after such a big investment that they'll want to finish and launch as soon as possible. But that's only around 9% of their cash on hand. So maybe it's more urgent for you than for them. Yeah. So maybe just can comment on all of
Well,
this.
I think there's no question it's more urgent for us than it is for them. So
Yeah.
they're a very big company. But you know how those companies work. There are people very vested in this project. I do check in with them on a regular basis. They had some issues in their development. They used an outside vendor that I guess they had some problems with. Our end is all done. Our stuff is all signed off on, design locked. We're ready to go. It created some challenges for us. I mean, we expanded our converting and packaging facility down in Texas, specifically partially because we knew AbbVie was coming, and AbbVie had some very strict demands of what they expected of us in terms of capacity and in terms of maintaining inventory and those types of
Mhm.
things. And then we were ready. We originally thought we'd start selling them in July of 24. And here we are today waiting for our first order, which hopefully will come soon, but we're still waiting, right? And then they've had 2 delays, and I understand why investors are frustrated, and I'm frustrated. And people always would ask me, like, what keeps you up at night? It's the things I can't control. And I can't control AbbVie. Now, Allergan is a really good company. The revenues to NextGel um, could be transformative if you do the math. I mean, if you just look at how they launch Cool Sculpt and you look at those number of machines, and then you figure that we're making, 2 8x8 pads minimally for every procedure, you can see that the numbers add up very, very quickly to become very, very large. And again, it feeds that gel capacity in my facility as well as the contract manufacturing down in Texas. So it's really important to us. Um, but fortunately, we're moving in the right direction without it. But if we had it, we'd be off to the races.
Hmm, got it. And can you sort of run us through the unit economics of those pads that you're going to sell them? So if that's possible, maybe it will be easier for people to model like and actually understand what are the practical implications of the AbbVie partnership if it ever happens.
Yeah, I mean, you look at it, just to give you some very, very rough guidelines because I don't want to get too specific. But if you think about, $8 to $10 a procedure, with a 40%, 35, 40% profit margin on it, it's a significant business for us.
Hmm. Yeah, I think that already helps quite a bit. And this is sort of a overlapping question, but I'll still ask it. Why have they delayed the launch so many times? And their website says the Resonic is still under development. So I guess I checked this out, and there's like a website where they share like the projects under development and what's the status there. And I don't know how often they update this, if this is reliable or not. But essentially, there is like um, when you go through the Resonic, there are like 3 stages, and they're in the development stage, and like yeah. So maybe you can comment on that.
Yeah, so I knew they wanted to make some changes to the machine. Remember, this was already an approved device that was in the market. There was like 12 of
Yeah.
them in the market, when they bought the company. And I think they had some design changes they wanted to make. They felt it was a little clumsy and large and heavy, and they wanted to make it better for the practitioners. And this is what happens, I guess. I mean, I don't want to. I'm not qualified to speak on the details because they don't share the details with me. But they had some issues with a particular vendor, is my understanding. And they got rid of that vendor and they brought the project in-house, and they're finishing it up in-house, and we expect them to be done soon. We will see. That's the story
Okay.
they tell me. I can't tell you I have any real insight into what AbbVie does. I'm not the first person they call when they have a problem, but I do follow them very closely. I do have good relationships with the team that we deal with there, and to the best of my knowledge, this project is moving forward.
Okay. Okay. Yeah, that helps a lot. And let's imagine a future where the AbbVie partnership doesn't exist. So can NextGel thrive long term? And it seems like you're on the right track without AbbVie. So yeah, what, like, let's say AbbVie decides, okay, let's not launch this thing. It's not in plans anymore. Um, would that give you more mental flexibility to kind of go and find new business, or like, yeah, how does it look like?
Well, I mean, after I get finished throwing a temper tantrum and throwing things around the house, because I'll be so upset. No, look, there was a challenge there because of the expansion that we did in the Texas facility. We built 12,000 square feet of additional capacity down there, including a 4,000 square foot clean room. So yeah, there was a moment in time when that facility was losing money because we didn't have the revenue coming in from AbbVie. But knock wood, we've gotten new customers like such as Cintas, Avcor, large companies that are now filling that capacity. So that facility has been profitable now 4 quarters in a row. And so it'll just be more profitable when AbbVie comes in, right? So yeah, I mean, look, there's other customers. I talk about it all the time on my conference calls that there's always customers in the pipeline. We talked about the long onboarding process. So I have visibility to more customers coming online, and I've been very open about that. So we'd be okay without AbbVie. We'll be great with
Okay.
AbbVie. So that's really the goal.
Yeah, yeah, makes sense. And we already sort of talked about Medtronic and how they are the only other capable kind of company to develop these hydrogels with the electron beam accelerator. So let's say they get a bit jealous and they actually see that there's a pretty big market and you're thriving and having great margins. Couldn't they like pivot or um, use their machine to compete with you instead of being a client?
Well, anything is possible, but it's unlikely. And the reason being,
Hmm.
first of all, they are an enormously big company. I forget what their market cap is, but it has a B on it somewhere. So they're for them, it would have to be a very significant business. We would have won already by the time they notice us.
Yeah.
Number two, a lot of the products, so they could probably make the product that we make for them because they know the specs, and they can make the product they currently make. But I don't know that they can make any of the other products because they don't
Yeah, true.
necessarily know how. So maybe they could copy it, maybe they couldn't, but once you're embedded in some of these companies, like we are in their 510K, and we're called out as part of a medical device, it's difficult to pry that business away because there's all new validations that have to be done. There's all new testing that has to be done. It costs the companies hundreds and hundreds of thousands of dollars. And, there's no reason as long as you're providing good service. Now, if you do something poor and leave them in the lurch or don't provide good service or provide shoddy material, yes, you can always lose a customer. You can't take it for granted. But if you do your job well in the world of med device, once you're embedded, it's very sticky, very sticky.
Got it. Yeah, that's perfect. And I sort of see NextGel as a hydrogel platform. So you have this platform, and you can basically go into several adjacent markets. So beyond healthcare, what are the most promising adjacent markets? I guess cosmetic is one of them. But yeah, can you speak for that?
Sure. So, well, healthcare is a very wide and broad term. So,
Yeah,
dermatology would fall under healthcare, but there's a lot of dermatological. Believe it or not, there's some aerospace applications that are very early stage that people are looking at. I guess keeping an airplane wing a degree cooler by using the water as a. And this is all theoretical stuff. There's nothing. I'm not saying anything that's like imminent or anything like that, right? So please take
yeah,
this
yeah,
with
sure.
salt. There are lots of applications, and I'm shocked and stunned by how many people keep bringing to us now. Because now we're a
Hmm.
little more out there, we're better well known. My contacts within med device companies have grown exponentially over the last 3 or 4 years, so that when someone's looking for something now, we actually get referrals. So it's kind of nice. You work kind of hard to get to this point, And now we're getting to that point where we have inbound calls with people saying, "Hey, could you do this? Can you do this? Can we put this in your gel? Will it cross link?" And so we have a very robust pipeline of research projects that, are in a wide variety of applications.
Yeah, I can imagine that's a very satisfactory like kind of feeling. I guess like 3-4 years is the minimum time frame to kind of get the ball rolling, and then it actually starts to compound.
Well,
So
the excitement comes from you think you have a good idea. You see the
yeah,
applications and you think you have a business. But until someone actually starts writing you checks and then reordering and ordering more and writing you more checks, you really don't
yeah,
know for sure. So once you see that happening, it's like, okay, this is going to go. And so, we're in the early days and it is what it is, and nothing happens as fast as you want it to, right? Especially for a small company playing beat the clock against its losses.
yeah.
But it is happening. And it is nice to see.
Yeah, I think that's the perfect segue into kind of the financial side of things and capital allocation. You mentioned obviously the losses, so you are burning cash at the moment, but you've been guiding to break even EBITDA in 2025, using EBITDA as a proxy for cash flows, of course. So, what gives you confidence in achieving this milestone, and what needs to go right for this to happen? Like, are you confident that you're on track to hit that goal?
Yeah, so the idea was that we'd reach that goal, not be for the entire year. We'd reach that goal, before the end of the year. And coming into Q4, we have to have a nice consumer products, Black Friday and Christmas. We need to get one more customer online, which we think we're going to have. So we need a couple of things to go right to get there. But and listen, I try never to miss guidance. I try to always beat guidance. But if you're $50,000 profitable EBITDA or $50,000 loss, but you have $2 million in the bank, I don't think that's a huge significant difference to the value of the company. We're getting there. We're going to
Yeah,
just get there the next quarter or whatever. But I would like to make it in Q4, and I think we have a really good shot.
right. Makes sense. And you talk about that $2 million in the bank, and if you look right now at the balance sheet, maybe one can be fearful of like whether you have enough cash to kind of fund operations and the current growth you're overseeing in the whole business. So how do you think about your ability to fund those operations and just the working capital, and whether you'll need, I think this is like the the most asked question for NextGel, but will you need to raise capital again, or anything like that?
Well, we just did raise a little bit, and we also got a cash infusion from Stada of $1 million.
Hmm.
So we added an extra $2 million onto our balance sheet 4 or 5 weeks ago. So that kind of puts us in a really good spot. We had about 700,000 left before that, so up to about 2.7. We reduced the burn from, I think it was 700 in Q1 down to 400, it was 500 EBITDA in Q1 and 700 in Q4 of last year. We brought it down to 400 last quarter, which to me was a little disappointing. I actually wanted to reduce it more, and we're going to continue to reduce it this quarter. So as you start to see that burn go down, that number becomes a lot more cushiony, right? So if you have $2 million in the bank, I'm just using round numbers. If you have $2 million in the bank and you're burning 400,000 a quarter, you've got 5 quarters worth of cash. If you're burning 200,000 a quarter, then you have 10 quarters in cash, and nobody's really worried about you. So it does make a difference. It is something we're very focused on, and we're hoping to do very well with that, starting in Q3, getting better, and then moving into Q4.
Got it. That's perfect. And sort of, if you wanted to slow down the growth in top line, would it be possible at your current scale to become profitable, or do you have to hit a certain economics of scale to make this work out? So both things have to go in the right direction, so the top line and like then the bottom line. Just trying to get a sense of of that.
Yeah, it's a little bit of both. And the reason is, as I said, when you're doing roll-ups in the record business, it's really easy, right? They're selling records. They lost their minds. They leased 7 Mercedes. You walk in the door, you get rid of the cars, and you're making money, right?
Yeah.
You get rid of all the fat. This is not the case. The reason that NextGel isn't profitable is only 2 reasons. Every division we have is profitable. CG is profitable, as I talked about for the last 4 quarters. Silly George makes money. Kenkoderm makes money. The Metagel products make money. The reason we're not yet profitable is because, one, public company costs, So you have to scale into that. And two, the facility. The facility is a large fixed overhead at 18% capacity. And anybody in contract manufacturing will tell you, you've got to do better than that. So look, we'll get profitable at a very low still for a facility. Like if we can get it to like 30% or 25% even, there's a good chance we'll break even or profitable. But that is what we have to do. We have to scale out of that because there was no business here when I walked in the door, and the facility has a lot of fixed costs.
Yeah, yeah, makes total sense. And I guess that also takes time. I mean, it's a matter of time, right? I want to speak for the dilution risk, right? So first of all, there are 4.7 million warrants outstanding. So I'd like you to comment on, like, obviously they have high strike prices, so I guess investors would be happy if the warrants were converted. Yeah, can you speak for what you would do with the cash inflows from the warrants, and also like the dilution risk? Obviously, this last inflow of cash that you had isn't dilutive, or most of it isn't dilutive, at least from the Stada part of it. So yeah, maybe you can just clarify all of
Yeah,
this.
the startup part's not dilutive. So I look at it this way: dilution is dilution if you're using it to cover your overhead, right? So some of this last raise, we did need a little bit of capital to like get the business to go. So that was a little bit dilutive, which hopefully the growth will offset that dilution. The startup money obviously was not dilutive. They gave it to us as an advance against future earnings with no requirement to pay it back and no stock being issued. So that was not dilutive. The warrants, I think about this way: they're none of them are cashless. They're all cash warrants. So if the stock hits 6 and the people started exercising their warrants at 4 and 5, yeah, you're adding 4.7 million, which would be another 25 million in market cap, but you're going to get about 19 million in cash, right?
Exactly. Yeah.
So that's not really dilutive because the asset value of the company rises. Now, the real question then becomes, do you think the CEO, me, is going to piss that money away? Or do you think I'm going to invest it wisely and make some strategic acquisitions that are going to be accretive to the company and then build the company out further? So I'd like to think I'm pretty well suited to do the latter. But that's really what happens when you get those warrant exercises and you get that additional dilution is you've now stepped up the size of the company. And honestly, if you're not going to take a chance, if you're not going to buy things, if you're not going to ramp, why are you public?
Yeah.
You're just paying costs for no reason.
Exactly. Makes sense. And so let's get back to the Stada financing. So I'm a big company, and I like Adam from NextGel, and I just give him like a couple of million to fund his
Or just one,
like
just 1 million so far. Yeah.
1 million to fund like the product. So why does someone do that, and what does it mean like for the like quality of the product, or was it like, how did you do it?
So Stada wanted to experiment coming into the U.S. We launched a product with them in September of last year called Histosolve. It's a digestive enzyme which addresses histamine intolerance, which is when you eat histamine-rich foods, people as they get as they produce less and less of the Dow enzyme think, oh, I'm just getting older. Every time I eat sausage, every time I drink red wine, I get terrible stomach aches. I get whatever. But actually, it can be a histamine sensitivity, and the Dow enzyme counteracts that. So we released that product in September. It's grown every month over month. They're very pleased with the job we're doing, to the point where this is actually the second amendment, them giving us $1 million. The first amendment, they decided to give us 2 more enzymes. We'll be releasing a gluten product for gluten sensitivity at the end of this, at the end of this year, beginning of next year. It'll be a soft launch in December, and then really come out in January. And they have 4 other enzymes they want us to put out. And then we saw some synergies, and I pitched them on trofolastin. Trofolastin is a scar product that does 9 million euros a year in Spain alone. It is a very well-regarded product in the Hispanic community here in the U.S., although as a very expensive import. And I think we could do quite well with it, especially because it has it addresses skin conditions, stretch marks, scarring, things that Silver Seal also addresses, right? So a nice combination, complete solution, right? You have a surgery, you have a procedure, you have an injury, you put Silver Seal on it. It's been shown to reduce the formation of scarring, and then you put trofolastin on so that whatever scar you do have is minimized or fades or goes away. So those products fit together, and they were very excited by the plans that we have. And they said, well, we want you to put these 9 products out. And I'm like, well, we don't have enough money to put 9 products out at the same time. And they said, okay, we'll give it to you. And that was sort of the
Mm,
impetus of it. They want the business to move forward, and they said, we'll advance it to the JV. Go ramp the JV. So really
makes
nice.
sense.
A company said, you're our
Yeah.
partner, and we'll give you the money to make both of us money. That to me was a great deal for us.
Yeah, yeah, for sure. It is indeed a great deal. And so I'm just thinking here, like, where did you learn marketing? Obviously, uh, it looks like you learned some of those skills, or like the organization learned or some of those skills through your past experiences at the record label companies, roll up, and like selling to the radio stations and getting a cheaper price for that. But maybe you can just guide us through your learning curve in marketing and the organizational skills learning curve in the
So
marketing
I draw on
space.
the marketing from those days almost all the time. So the
Mm-hmm.
ultimate consumer product is music. You don't know what the market's going to like. You really have to read the data. I used to. I had a partner in my promotion company, and people used to joke with him because he wouldn't listen to the record we were actually being paid to promote. And they're
Yeah.
like, "Well, why not?" And it's like, "'Cause I might like them. And if I like them, then it's gonna skew, my judgment of it. I might spend too much money on a bad record, right? Just tell me how many spins it's getting on what radio stations and how much it's selling, and I'll tell you if it's a hit, right? That's what it goes to." And I had a very successful product, in the '90s called Dance Mix USA. It was a compilation product. We did infomercials on TV. So it was direct to consumer TV advertising. And
Mm-hmm.
yes, today we have Meta and Instagram and algorithms, but the basic math is the same, right? You have a cost to acquire a customer, you have the stickiness of that customer, you have the advertising allowable on your profitability, and you have to watch these things very carefully so your advertising costs don't spin out of control and eat up all your profits. And it was actually a lot harder to do it in the '90s before computers were were analyzing this stuff as than it is
Mm-hmm.
now. But
Yeah.
but the math is all the same.
Got it. Perfect. So let's play a thought experiment here. So let's say you're long term, you're at the right scale, and you have onboarded like couple of clients and so on. Like, what sort of EBITDA margins would you be targeting, and do you think it's possible for the long term? Obviously, it's not like a guidance, but something that would make sense, and yeah, with your current model.
Yeah, so it's kind of a complicated question because the two different business lines are so different. And I get this question. If you ever listen to any of our conference calls, someone will always
Hmm.
ask me like, "Wow, great gross margins." I'm like, "Don't even look at our gross margins, okay? Because my gross margins are skewed. When you have
Yeah,
when Silly George does really well, all of the real costs for Silly George are the advertising below the line, right? So the gross margins look
exactly.
amazing, but that's not real. And the same thing is true, with the contract manufacturing. So I would love the consumer product side to grow. Consumer products always has the ability to grow much faster than you thought it was going to, or slower,
Hmm.
because consumers are fickle, right? So you
Yep.
put out a product, and this is the nature. We don't know, right? We put out a product we think is amazing, and it sells meh. And then you put out a product that's like, okay, well, here's a little accessory we'll throw out. It goes viral, and the next thing you know, you have an $8 million product, right?
Yeah.
Those things do happen, and you have to run your business not knowing what's going to happen. So we're
Exactly.
hopeful that we're going to get lucky with a few of our products that are coming out. We think they're really good, but we don't know that for a fact. But if they are, that could be the fastest growing segment of our business. On the other side, it takes a long onboarding, but there's a couple of machine type things like the AbbVie machine where we're literally the razor blade in a device. And if those devices take off, that side of the business could be another 3, 5, 8 million in revenues and completely dominate consumer products. And
Hmm.
the exciting part when I wake up every day is I'm not sure which one it's going to be. It could be both. It could be, they both could grow slower than I'd like, but they're both going to grow. And the question is, which one's really going to take off? I don't know. I mean, they are very different businesses.
Hmm. Okay, makes sense. And let's talk a bit about the risks. I think we already talked about the operational risk with the e-beam machine, but like what risks are you currently concerned about yourself and trying to do your best to minimize in the business? Technically, with the products, I think you have pretty, yeah, you have already a stable kind of process in there. But financially, competitively, and like just operationally, what are the biggest challenges? I think I already know what you're going to say, but yeah,
What would
let's
tell
hear.
me? What am I going to say? What's your
I
guess?
think you're going to talk about like the capacity of the contract manufacturing
Yeah, I mean,
facility.
look, but that's not really a risk because we have lots of capacity, and I don't have to worry about that for quite some time. So that's actually comforting.
Huh?
And
Okay.
in the place where we had a bottleneck was in converting and packaging, but obviously the partnership with CG and the facility we built in Texas has eliminated that as well. Um, it's really the things I can't control. Like I know there's
Okay.
a demand for this product. I know we can onboard these customers. It's about what I can't control is, you know, most of these folks are going in front of regulatory bodies. So there's another customer that I'm very excited about. We haven't announced it yet, but I've told everybody there's a pipeline of customers, and they're about to start their process. We've been developing the product with them for 2 years. They're about to start their process for CE mark and FDA 510K. If that goes smoothly, the product could be out in a year. If it goes with hiccups and bumps, it could be out in 2 years. Completely out of my control and a little bit out of theirs, right? Because agencies are agencies, and you never know. So, the speed and rate at which things can happen is probably the biggest worry that I have. Like, I want things to go fast, and sometimes they do, and sometimes they're a little slower.
What's sort of the long-term vision for NextGel? Like, what should investors kind of track going forward for the long run? And yeah, just where do you see the business in say 5-10 years time?
So hopefully in 5 or 10 years' time, we've embedded ourselves in multiple medical devices that continue to grow at different CAGRs, but they're all growing, and we continue to onboard new folks, and that business just continues to get larger and larger. I think we're in a fortunate time where in-home monitoring, self-monitoring, the things that you would attach things to yourself on, which is where we shine, are getting larger and larger, are going to become more and more a part, especially with the elderly, of just normal consumer behaviors and information being fed in real time to doctors. So I think we're in a really good place there. I can see that continuing to grow. Adding brands and building a real consumer products company that may someday get spun out, may someday stay with this company. I'm not sure, but those are like two very distinct businesses. And hopefully within 5 to 7 years, we will have realized some of the value from our aspirational programs. We're very excited about our Premolast patch and the results that we've gotten with a few patients that we've tried it on, and the delivery data that we have. We've shown some great data on delivering diclofenac. We're still working on our surgical drapes for cataracts and/or surgical incise drapes. So again, some of those are taking a little bit of a backseat because of all the flurry of activity around other things. But over the next, several years, we're going to devote some resources to all of those things because they deserve it when we can afford to, and when the timing we can afford it both in terms of money and time.
Mhm.
But I think, in 5 to 7 years, you should see some results from that too.
Yeah, to that point, I'm really curious about how do you find the resources and how can you get so creative with like new things to launch and so on with like limited resources, of course. Like when you're burning cash, I guess you're trying to minimize costs everywhere. So I'm really curious about how are you able to still innovate within the organization you already have. Obviously, you can always add some innovation from outside, like by acquiring some technology or something. But you already shown you're capable of kind of innovating within what you have.
So a couple things. Part of our consumer products business, when we're innovating something that we're making with our hydrogels, that's all in house. And
Hmm.
as I explained, you already have a pretty large fixed overhead with chemists and polymer scientists, and we do all that stuff in house, and I already have them there. We do it in our spare time, so it
Yeah.
doesn't really cost us any money. When we find something great, like a silly George, well, now we're just buying product from a contract manufacturing. We don't really have to spend a lot of money innovating that. Uh, to be clear, all of these projects that we're working on and really cool med device applications for these larger companies, they pay us up front. We don't
Mm.
do that work for free. So if you came to me and said, Adam, I really like NextGel to put, this incredible hair growth thing I have into a hydrogel. Can you do it? I'll say, well, I can try and I can make you samples, but it'll cost you $15,000.
Yeah,
So, these companies pay us, and we try to keep the cost reasonable because we want to encourage them to
of
come and
course.
try and use our technology. But that's really a, a test of if you're a real customer, right? If you're trying to invent something new and you can't develop or devote $10,000 to $15,000 into your prototypes, then you're not a real customer in long term. So we don't really have to pay for a lot of the innovations that we come up with.
Mm, got it. I want to talk about a bit your past again. So you were an investment banker at some point, and so what is something that you see that investors misunderstand about actually running a business, or that you would like investors to understand a bit better um, about like actually operating something? Because I think we are sometimes a bit impatient, and we don't put ourselves in the shoes of the CEO many times. And so yeah, I'm giving you the platform to kind of teach us.
Yeah, I mean, let me think about that for a second. The typical investor is concerned about sometimes the very right things, right? Being concerned about dilution, being concerned about, is the company moving in the right direction, is the company turning things around. But a lot of times investors are very focused on those things and are not thinking about the time it takes to get some of this stuff done. But again, you have to rely on the CEO for that. I don't find investors to be, in any way, like, ignorant or ask dumb questions, or I get really good questions from investors, and I often get things that make me think about, well, wait a minute, am I missing something here, or,
Hmm.
or should I look at that? The investment banking background that I had really helped in this sense, right? When I was running one business, you're running your one business, you know that business. When you start looking at other businesses as an investment banker, you're doing the same job as an investor. You have to really start to think about what can go right and what can go wrong in that company, and is management able to handle it? And I knew a great analyst that ran a hedge fund, and as he went through his process, and his process was like most investors, like, what's your cap table look like? What does this look like? What is it growth? But at some point in his process, there was always a question he asked where the correct answer was, yeah, that's a risk. And this is what we're handling that risk. Here's what we're attributing to that risk. Here's how we're going to try to mitigate that risk. But it is a risk. And if the CEO that was pitching him said, there's no risk, that can't happen, he was out.
Hmm.
And so,
Yeah.
all of these businesses have risks. They all have things that can go wrong. I think most of your savvy investors who've been doing it for a while have seen very often things generally don't go exactly according to plan, but it's how well you can pivot, adapt, do what you need to do to keep the company alive, that generally means the difference. And when I was a banker, doing micro caps predominantly, small caps and micro caps, there's a saying that, 95% of the risk is in the jockey. It's in,
Hmm.
because something's going to happen. Something's going to happen, bad. Something's going to happen that you have to change. Something's going to happen that has to be addressed. Can that person change and make the necessary adjustments? And that's really what it comes down to.
Yeah, I think it's very interesting to have like because you have both perspectives, right, from the investor side of things and also the operational side of things. I think there was only another CEO I spoke with that actually was an investor as well, and sometimes it's hard to kind of have both views, right? Um,
But
yeah,
it can be very valuable, right?
yeah,
Because, people look at our company and they go, wow, you have such a clean cap table. You have no preferreds. You have no toxic debt. These are things that I've seen destroy companies, right? In
yeah,
my,
yeah.
in my experiences. Now, these are things that I know as an investor I don't like, right? I don't like a CEO who can't get diluted. All of my stock that I own is common shares.
Hmm.
So that if I do something or make a mistake, and people do sometimes, I get diluted along with everybody else, right? I'm no different. I don't have this. There's always been a disconnect for me with some of these CEOs that have, non-dilutable stock, and so, like, he doesn't care. All he's trying to do is hang on to his job because he's never going to get diluted. I prefer to be in the trenches with the investors, and I like to think that every action that I'm taking, I'm considering what's best for them, because
Mm,
that's actually my fiduciary duty.
yeah, yeah, makes sense. And so um, I think it's also interesting to talk about like your communication strategy with investors, because obviously as a small company you kind of have to fight for investor attention. um because yeah, you're often overlooked and so on. So I'm curious to know what's sort of your strategy to getting the story out there. I think you're already doing a good job, but yeah, how do you think overall about investor relations and communication?
So it's really important. I can't go to all the conferences, but I do try to go to 2 or 3 important ones a year and talk to folks and do presentations so people can see what's going on with the company. On our conference calls, I will take every question. I instruct them all the time. There's no question. You don't screen the question. You just let people go, so I can get as much out that way. I do things like what we're doing right now. I've done a few others that are now appearing on social media, just explaining current events and what's going on with the company. But the reality is look, there's two roads. There's like the dark path of being promotional, which only lasts for a short period of time, and then you're right back where you were, and all you've done is spend money, and it goes up and it goes down, right? And that's not what we want to do. I always look at it as, if I continue to execute, we'll I'll be rewarded. The stock will be rewarded. Now, in a frothy market, it'll get rewarded more than it deserves to be. In a bad market, it'll get rewarded a little less than it deserves to be. But if we do what we're supposed to do and we operationally get to a profitable business that gets stronger every year, things will take care of themselves.
Isn't it crazy that 80% of you aren't subscribed? So if you made it this far, here's my promise. Follow or subscribe for free, and my team and I will make every episode 1% better. Check out the last episode too if you enjoyed this one, and thank you so much for listening.